All right, and welcome back for another episode of This Week in Charts via Carnivore Trades and Wall Street from Main Street. If you've not done so already, give the video a thumbs up, like, comment, subscribe, etc. Come find Jason on Patreon for his premium service, and come find me on carnivoretrades.com for swing trading alerts and analysis. Anyways, so last week we saw the bottom really kind of fall out of this market here. That spider level that I gave you failed. So this white line right here, that green bar low of 407.70, I said if we get any close or break of that level, we're going to go down very quickly. And you can see late Thursday afternoon, if we flip over here to the intraday, as soon as that level gave way, it was just kind of waterfall selling here before we finally stalled out a little bit on Friday. And that just shows you the power really of failed patterns. And we had nice bullish consolidation here, and the bulls couldn't hold it. That's the bottom line. You see the same thing there on the triple Qs. So 302.42, that green bar low. Nice bullish chop here. And as soon as that level broke, the market broke down. It looks to me like the CPI number was probably leaked, honestly, sometime Thursday. I mean, as you can see here, really late in the afternoon, and really all week, we were basically chopping for a week and a half, 2 weeks here. And then all of a sudden we just start selling Thursday afternoon out of nowhere before the CPI number, which was the catalyst for the big drop. So it looks like somebody leaked that. The strange thing here is that the market kind of reacted initially as if a hot number is kind of a surprise, right? So, I mean, it's like, who didn't really expect a hot number? I don't think anybody who's been to a grocery store in the last 6 months would have said anything otherwise. So it's interesting to see that the market reacted as if it was a surprise, like we were expecting inflation to just stop or something. I don't know, maybe too many people were thinking there was going to be a peak. That's possible, but to me it just seemed a little bit suspicious that the market reacted as violently as it did. But it is what it is, and that's what happened here. Gave the bulls kind of the benefit of the doubt, saying, hey, we got bullish pattern here for a possible move up into that 430 area. And obviously they just couldn't hold it. So we came right down Thursday and then gapped down Friday, and we sold into the last 10 minutes. Traders not really wanting to hold into the weekend, so that makes sense. Now it's really all eyes on the Fed. Next week we have the FOMC on Wednesday. We'll see what they say. Obviously the market has now priced in the worst. So your positive here, if any, is that the market's priced in an exorbitantly hawkish Fed. So now the market already expects that. So there's your small positive there. The other positive is that it is OPEX week, and it is a quad witching OPEX. So there will be lots of game playing. And like I said, it's suspicious that the market sold off as violently as it did, as if we were expecting a strong, or a cool number. So the thought process is that you get a bunch of people on board buying puts, and then you kind of push the market in the opposite direction off of the FOMC perhaps, which could make those puts expire worthless. Again, this is just speculation, but just a few things to consider here. Bottom line is we did roll over pretty sharply, and a lot of charts here are near 52-week lows or close to it. These semiconductors here, very close to 52-week lows. IGV, cloud software, basically testing the May highs here, the area that you broke out of. Dow transports are very close to 52-week lows now as well. So leading sectors showing a lot of weakness here, and they got to be respected. This is a bear market. Sometimes these levels don't get as high as you expect. We're looking for a move possibly to that 430 area before this leg started selling, but in a bear market, sometimes you don't always achieve those upside targets. Just like in a bull market, you don't always achieve the pullback targets. So that is kind of the nature of it. In any case here, moving on to interest rates. So 10-year treasury yield got a strong bid on Friday, obviously, with the CPI number up 3.68% there. We did have the 5s and 30s invert. So we do have an inversion again, and the 2s and 10s are close, but they're not quite there, but they are very close. They're getting closer. And this inversion did hurt high yield debt. So high yield debt now, HYG back at 52-week lows. making fresh 52-week lows, so that's getting roasted there. Financials obviously not liking that inverted yield curve, so XLF down very close to a new 52-week low here, down 3.61% on Friday. And broker dealers, again, down 3.54, very close to 52-week lows as well. So rates inversion having an effect on financials, having an effect on the bond market. I'm still not necessarily convinced, though, believe it or not. I'm still not necessarily convinced that yields are ready to break out just yet. At least one more time. I still think they have to do a little bit more back-end filling. But, we'll see what we get. Again, it's a quad witching OPEX. We got the Fed next week. They could throw a wrench into everything. So just keep that in mind. Also getting affected by the inversion, VNQ here. So real estate ETF, fresh 52-week lows this week, taking out this tail from May. So we'll see what that does next week on KRE regional banks, very close to a 52-week low. I had a short level on this just above 66. We just didn't quite get there. I wanted to take this as a short. Same thing with ITB, home builders here, rolling over as well. And, I wanted to get this right into that 100 moving average. I thought we would get that one good leg up. But again, like I was just saying, sometimes you just don't get those upside targets in a bear market. So, I mean, there is good short opportunities I was looking for here, but that's just kind of the nature of the beast. Sometimes you get these bullish patterns and they have a higher tendency to fail when you're in a downtrend. And that looks like that is what happened. But in any case, home builders, financials getting hit really hard with the higher yield and the inversion there on the chart. Anyways, here, energy. So crude was actually relatively quiet Thursday and Friday considering the sell-off here, but it's holding up really well. I still think 125 is kind of the big level for this. If this starts to flag, though, it's going to make that level a little bit more minor here, but we'll see if we get some type of a really, I was looking for kind of a bigger push here, maybe kind of like a blow-off move into summer before a big correction in crude, but we'll see if we get that. It's holding up really well. I can't say anything bad about it at the moment. Same thing with XLE. If you look on the charts here historically, you're getting very close to all-time highs. There should be a lot of resistance in that 95 area, 96, 97 on the monthly, and it's it's gone parabolic into that. So just be careful of that. And I just tell you guys, don't chase these up here. Let them have a correction first. You don't need to be buying up here because CNBC tells you to. This never works out the right way. Wait for them to correct or consolidate or do something. Do some serious backing and filling. Like they did kind of all, really 2021. So they were still in an uptrend, but they, they had a nice consolidation. Don't chase them up here. They will correct. You'll get a chance to buy them again. So just bear that in mind. But XOP, same kind of thing. And OIH coming off the highs a little bit here. But same thing with all these energy plays. Just be careful with them and don't chase. Nat gas here. Pulling back a little bit this week. Again, we had that, the explosion from that Texas LNG facility. Basically, short term, it can cause nat gas to come back in a little bit. Long term, it really doesn't amount to a hill of beans. But, nat gas holding up. Basically been holding that 20-period moving average really since April. Actually, you could say since March. And that's been holding up well. I still think nat gas gets above $10 before it has any sort of significant pullback. So we'll see what it does over the next couple of weeks. But it's held up really well considering that, it basically crashed 13% in 1 hour on Wednesday. And then it continued lower down to $8 on Thursday and rebounded pretty sharply. So nat gas has been holding up really well. Can't say anything wrong about it at the time. I still think, again, though, it gets above $10 before has any sort of major kind of backing and filling moment. So let's look at uranium here. So CCJ, what did I tell you guys the last couple of weeks? $28. That's going to be the level before it goes to before it pulls back. We got up there, $28.28, and a nice sharp pullback, finishing at $25.53 for the week. URNM, where did I say that was going to go? 75, got up to 76.54, so piercing above that a little bit, and then pulling back to 68.38 for the close here. So basically, you just went into this breakdown bar here, and it was also a 50% fib retrace. That was really the level I was looking for here, but these uranium plays are actually holding up a little bit better. You see the 50% fib there. These uranium plays are holding up a little bit better than some of the other equities, not anywhere near the May lows, whereas you look at, the spiders here, it's basically it's almost there. You look at, we showed you XLF, and all those other sectors, semiconductors and so on. But the uranium plays are holding up really well, possibly putting in a higher low here. Now, I need to see a little bit of backing and filling, and then it can go up here and attack these, this red bar. But this is a big breakdown bar here, so just be aware of that. It's going to need to do some chopping before it can get through that. But a nice little pullback there on URNM and CCJ after hitting those targets. So nice move there. IPI and Mosaic. I told you guys last week, I was a little disappointed. I thought these would get a bounce here. I said they might be setting up to move lower, and they did start to fade a little bit with the market. I'm not sure if the higher energy costs are really kind of the catalyst here. Could be something to do with that. But ultimately, I think this Mosaic wants to get back to 45, 47 here in the near term, and I think that would be a good area for a good bounce. That's right where you broke out of, so somewhere in that range on Mosaic. And the same thing on IPI, actually, about 47 bucks, 47.50, somewhere in that area. If it gets through that, I would look at about 45, excuse me, not 45, 40. So right around this area here, that's where I would look for if it got through that. But yeah, the potash plays have faded a little bit, and surprisingly, but those are the levels I like. That's basically retracing and retesting that breakout area. All right, anyways, dollar index. So that bear flag kind of scenario that I was talking about is basically negated here after the surge Thursday, Friday. Again, makes sense, right? Flight to safety, markets are selling off, going to be higher demand for dollars. So again, not necessarily convinced that it's done backing and filling, just like yields. This has had a positive correlation with yields really for quite a while here. And, if yields don't break out, then the dollar is probably not going to break out. So we'll see what it does here. We'll see if the Fed says something that changes things. But dollar holding up pretty strong. And gold also doing exactly what it needs to be doing here. Look at the surge on Friday. As the equity markets sold off, you saw a huge surge in volume on gold and a nice reversal there. Take a look at the candle on GLD here. Look at that engulfing reversal on GLD. So basically gapped down to the lows here of the last 3-4 weeks, and then closed above the highs of the last month or so. So big move on GLD, GDX, same thing, gap down, and a huge reversal there with good volume. So gold's doing what it's supposed to. It's acting as a safe haven. It's outperforming the stock market right now. It's outperforming crypto. It's outperforming a lot of things. Really, other than yields and the dollar index, gold is really, it's holding up well. It's doing what it's supposed to. It's a store of value. It's doing all the right things here. Now, the other metals, silver, and by the way, I think gold, probably gets up to 19, maybe 19.20. So that's kind of what I'm looking for here in the near term. I don't think it can get through that at the moment, but that's kind of like the short-term upside targets right now. But silver, it did have a nice reversal here on Friday, just like gold did, but not as impressive as gold. I mean, he had a nice reversal there on SILJ. I like that move there. So that is a good sign here. But some of the industrial metals here, platinum, palladium, and copper. Look at copper here. It's completely negated that surge that we had last week. So some of the industrial metals kind of suggesting more so that, the inversion of the yield curve is going to, and the Fed raising rates aggressively is going to cause more of a recession. So that seems to be what the market's kind of thought process is here. So the industrial metals performing a little bit less strongly than gold. But overall, again, gold doing what it's supposed to. And that's really the bottom line here. Anyways, so crypto here continuing to sell off. Again, we talked about how weak it was here. And again, this is the level I gave you. Just like the spiders here, you had that big green bar. And I told you guys 29,295 spot 86. If we close below that, you're going to see selling in crypto, and we're seeing selling in crypto. So we got below that level on Friday and then selling Saturday, Sunday today. So it does look like Bitcoin's going to come down here and test this tail candle. I don't know if it necessarily gets down to the low right away, but you almost kind of like a fake breakout here with this little surge here, and you never got above these pivots, and then you tried to come back up and couldn't take out this red bar, and then it just rolled over. So Bitcoin weak, crypto weak. Ether has already taken out this tail candle, basically tested it once, got a bounce, came back down, bear flagged again, and rolled over. Crypto is weak, guys. So Again, it's acting like leveraged NASDAQ, and you know what happens when you have leveraged NASDAQ with higher rates. It's basically risk off for these types of plays. So I don't like crypto. I don't like anything it's doing at the moment. It looks like Bitcoin wants to go down and finish this head and shoulder pattern here, and really test that 18,000 area. Let's see if we can show you here. There we go. So that big head and shoulder pattern, it's got a target of about 18,000. So we'll see if it gets down there. But again, nothing really great here on crypto. You lose that green bar, and again, the power of failed patterns. I see it all the time here in the market. Anyways, so lastly, your only positives here going into next week are that if you look at volatility, look at the VIX here, it really came sharply off the highs on Friday. Part of that is because XLE is holding up. So if every sector isn't beat red, you know, XLE was red on Friday, but it wasn't like ridiculous. It wasn't, you know, down 3-4%. But if every sector isn't beat red, the VIX isn't going to pop all that much. Now, the negative here is that means the VIX could have a lot more to run. So it could, you know, we haven't even really seen fear set in yet. But it can be a leading indicator sometimes if the VIX isn't really selling, or the VIX isn't really popping and the market's selling off. Sometimes it can indicate kind of a head fake move. So that's something to consider. The other thing to consider here is the Russell 2000, which is a small cap index. It's basically a risk on index. Really wasn't down that much. I mean, it was down 2.7%, but the NASDAQ was down more and the spiders were down more on Friday. And this is still well off the 52-week lows. It's actually still basically testing the May highs. You know, outside of this one outlier candle, you can see here that it was kind of just stuck in this little range here. And the Russell actually finished slightly off the lows compared to, you know, the spiders, which sold right into the close on Friday. So you can see that sell off, you know, no bounce into the close, whereas the Russell finished off the low. So again, the Russell can be a bit of a leading indicator. So again, I wouldn't put too much behind it, but it is something to at least respect here. The other little positive is that it's, again, like I said, it's OPEX week and it's a quad witch. So they could really, you know, this could be one big rug pull, you know. I mean, they could beat us down early in the week, and, you know, obviously Thursday, Friday, and then they could, you know, rug pull us and have us have a huge surge Wednesday, Thursday, Friday off the FOMC. You know, maybe the Fed comes out and isn't as hawkish as people expect, and, you know, that could give you a little bit of a relief. So that's really the positives here. If we do flush, and that's regardless of, you know, if we do next week or the week after, I think it'll be quick. We'll probably bottom within a week or two, and then we'll probably have a summer rally into July and August. And by rally, I don't mean like, you know, 15-20%. I mean, we'll have a relief period. So, you know, we'll have kind of the equivalent to backing and filling, but to the downside as to the upside. So we'll, you know, a period of a little bit, things are getting a little bit calmer and quieter. But that's kind of what I'm looking at. The other thing, if I can make one last comment, is that OPEX week, typically the market doesn't crash during OPEX week. The dealers want to have control over the market. So if we do crash or have some type of a washout, I think it would be the week after. So we'll see what we get. Again, all eyes are on the Fed Wednesday. So that means Monday, Tuesday, we may be a little bit quieter, as, you know, traders are just going to be kind of waiting on the Fed and waiting to see what the FOMC does. But we'll see what we get next week. In any case, don't overload yourself. Don't get too aggressive with positions. There's no clarity right now. Again, with carnivore trades right now, we're very, very, very much in cash right now. So just let the institutions be the heroes. There's no need to be the hero at this point. Just let the market tell you what it wants to do and don't chase it. All right, guys. I'm going to wrap it up here. You guys take care. Come find Jason on Patreon. Come find me on carnivoretrades.com. And I will talk to you all next week.